Hello everyone, welcome to another video. In this video, we are going to look at weighted average shares. If you have seen my video on earnings per share or EPS, you would have seen this term called weighted average shares, which is used in the denominator of the EPS formula. In this video, we are more specifically going to look at how to calculate weighted average shares. So first thing first, what weighted average shares are? Weighted average shares are basically calculated by multiplying an outstanding number of shares after considering issuance and buybacks of shares in each reporting period. So it's the equity, but time weighted. It's a time weighted portion of equity. This, as I said at the start of the video, this number comes up in the denominator when calculating earnings per share. So the formula for EPS is actually the net profit over weighted average shares. So let's look at an example on how to calculate weighted average shares, right? So opening balance, this is year 2000, and then at the opening balance at the beginning, the company had, and an entity had outstanding shares of 100,000 or 100,000 shares outstanding. Then during the year on 1st April 2000, the company issued 20,000 shares. And then on 1st April, company had an equity of $120,000. Then on 1st June 2000, 30,000 more shares were issued, coming to a balance of 150,000. On 1st October, another 50,000 shares were issued. Coming to a total balance of $200,000. So the closing balance of equity is now $200,000. But when we calculate the EPS or earnings per share, we need to take into account the weighted average shares. So we basically factor in the time. Of these newly issued shares or in these newly issued shares. So let's look into how we can do that. So 100,000 shares, they were outstanding for the whole year, 12 out of 12 months, right? That's the time factor. So these 100,000 shares were outstanding for 12 out of 12 months. Then the company issued an additional 20,000 shares, on 1st April, right? So from 1st April to 31st December, how many months is this? That's exactly 9 months. So therefore, we will factor in the time in here. So 20,000 times 9 times over 12, right? 20,000 times 9 over 12. Then the company issued another 30,000 shares on 1st June till 31st December. These shares would have been outstanding. So these shares were outstanding for how many months? These shares were outstanding for 7 months. So we will multiply 30,000 by 7 over 12. And then lastly, an entity before the year end on 1st October issued another 50,000 shares, and those shares remained outstanding. For 3 months. Those shares remained outstanding for 3 months, right? So we will multiply 50,000 by 3 over 12. We will multiply 50,000 by 3 over 12, and then we will do the addition. And that this would come to 145,000. So the weighted average shares in this example would be 145,000. These would be the weighted average shares. Thank you for watching this video. I hope this video was helpful to you. If you find this video helpful, please give it a thumbs up and subscribe to my channel for more of such videos. Thank you very much.